Gold is supposed to be the safest store of value in human history, and for thousands of years it has been the ultimate hedge against inflation and currency collapse and economic uncertainty. The price of gold does not move the way it should, and when currencies collapse, gold should skyrocket. Yet sometimes it does not, and when inflation explodes, gold should surge, yet sometimes it stays flat, and when central banks print trillions of dollars, gold should moon. Sometimes it barely moves. This is not natural, and this is not market forces. And this is not supply and demand, because central banks and governments actively manipulate the gold price to protect their currencies and their power. This is the story of how gold became a threat to the system, and how that system fights back every single day to keep gold suppressed. Welcome to Paper Empires, where fortunes are built on lies. Why gold threatens the system? To understand why central banks manipulate gold, you need to understand what gold represents. And gold is a vote of no confidence in government currency. When people buy gold, they are saying they do not trust the dollar or the euro or the yen, and they do not trust central banks to maintain the value of paper money, and they are protecting themselves against inflation and devaluation and collapse. This terrifies central banks because their entire power structure depends on you believing in their currency, and if everyone starts hoarding gold instead of holding dollars, the entire monetary system loses credibility. Gold is money that cannot be printed and cannot be debased and cannot be controlled. And that makes it dangerous to governments that survive by printing money and debasing currency and controlling what you use. So central banks have spent decades suppressing the gold price to make it look like gold is a bad investment compared to holding dollars or bonds or stocks. And they do this through multiple mechanisms that most people do not even know exist. Think about this for a moment. Every time gold starts rising too fast, threatening to expose currency weakness, central banks intervene to push it back down, and they have done this for 50 years. Paper gold versus physical gold. Here is the first manipulation mechanism, and it is called paper gold. And this is the key to understanding everything. Physical gold is actual metal bars and coins that you can hold in your hand. And there is a limited supply because gold must be mined from the ground, and mining is expensive and slow. Paper gold is a promise to deliver gold, and it trades on exchanges like COMEX, the Chicago Mercantile Exchange, and the London bullion market. And these are contracts that say you own gold, even though you do not actually possess it. Here's the scam, and exchanges sell far more paper gold than physical gold exists. And estimates suggest that for every 1 ounce of physical gold in COMEX vaults, there are 100 ounces of paper gold traded. This is called fractional reserve gold, and it is the same scam banks use with your deposits. And they lend out money, they do not have betting. You will not all ask for it at once. So when you buy paper gold on COMEX, you think you own gold, yet you own a piece of paper that says someone will give you gold someday, and most people never take delivery, so the exchange just keeps selling more contracts backed by the same physical gold. This floods the market with fake supply, and when supply appears, infinite price cannot rise, and this is how paper gold suppresses physical gold prices. If everyone holding paper gold demanded physical delivery, the entire system would collapse, because the gold does not exist, and this has almost happened multiple times, and every time it does, central banks intervene. Think about what this means, and the gold price you see on TV is not the price of gold. It is the price of a promise about gold, and those promises outnumber the real gold by 100 to 1. Central bank gold leasing. The second manipulation tool is gold leasing, and this is where central banks lend their gold to bullion banks at near zero interest rates. Here's how it works, and central banks own massive gold reserves stored in vaults, and instead of letting it sit there, they lease it to banks like JP Morgan and HSBC and Goldman Sachs. These banks then sell that leased gold into the market, which increases supply and pushes prices down, and they use the cash from selling the gold to invest in higher return assets. Later, they buy back the gold at hopefully a lower price, return it to the central bank, and pocket the difference. Here is the problem, and if the price of gold rises instead of falling, the banks lose money, and if the price rises too much, they cannot afford to buy back the gold, and the central bank might not get their gold back. So central banks have an incentive to keep gold prices low to protect the bullion banks they lend to. And this creates a coordinated suppression system. The Bank for International Settlements. The Central Bank for Central Banks has admitted that central banks engage in gold swaps and leases. Yet they refuse to disclose the amounts or the terms because transparency would expose the manipulation. Estimates suggest central banks have leased out between 10,000 and 15,000 tons of gold, which is about half of all official central bank reserves. And this leased gold has been sold into the market, creating artificial supply. And here is the kicker, and central banks still report this leased gold as if they own it, even though it has been sold. So their balance sheets lie about how much gold they actually possess. Futures market manipulation. The third manipulation tool is naked short selling in the futures market. And this is where it gets blatant. On COMEX, traders can sell gold futures contracts without owning any gold, and this is called naked short selling. And it is legal in commodities while being illegal in stocks because it is recognized as market manipulation. Here's how it works, and a trader sells 100 contracts promising to deliver gold at a specific price, and they do not own the gold and do not intend to deliver it, and they are just betting the price will fall so they can buy back the contract cheaper. When thousands of these naked short contracts flood the market at once, the price drops because it looks like massive selling pressure, and this triggers stop losses and algorithm trading and panic, and the price collapses. This happens consistently at specific times during low volume trading hours, usually during Asian market hours when fewer traders are active. and large short positions appear out of nowhere and smash the gold price down. These are called spoofing attacks, and they have been documented and prosecuted. JP Morgan was fined nearly $1 billion in 2020 for spoofing gold and silver markets, yet the fines are tiny compared to the profits, and the manipulation continues. The key is that these short attacks happen during low liquidity when a small amount of selling can move the price dramatically, and they are designed to trigger stop losses and shake out retail investors and create fear. And who benefits from lower gold prices? Central banks and governments that issue fiat currency, because low gold prices make their currencies look stable by comparison. The London Gold Fix. For decades, the gold price was literally fixed by a small group of banks meeting in a room in London, and this was called the London Gold Fixing, and it determined the global gold price twice a day. 5 banks would meet and agree on the price, and that price would become the benchmark for global gold trading. And this system ran from 1919 until 2015. Think about that. And the most important commodity in human history had its price set by 5 banks in a private meeting with no oversight and no transparency and no regulation. In 2015, the system was reformed after scandals revealed that traders were front-running the fix and manipulating prices. Yet the new system is still controlled by banks, and the manipulation continues, just with better PR. The London Bullion Market Association still oversees gold trading, and the same banks that were caught manipulating the fix are still the dominant players, and the price discovery mechanism remains opaque. Why does London control gold pricing? Because the Bank of England holds massive gold reserves, and London is the center of the bullion banking system, and the system was designed to benefit the banks and central banks, not the market. The Fed and Gold Suppression. The Federal Reserve has a direct interest in suppressing gold because rising gold prices signal dollar weakness, and the Fed's entire mandate is to maintain confidence in the dollar. In the 1960s, the US was hemorrhaging gold because foreign governments were exchanging dollars for gold under the Bretton Woods system, and the Fed was running out of gold. So the Fed and the Treasury created the London Gold Pool in 1961, where central banks coordinated to sell gold and suppress the price and prevent a run on US gold reserves. The gold pool collapsed in 1968 because the demand for gold was too strong, and this led Nixon to close the gold window entirely in 1968, 1971, ending dollar convertibility to gold. The suppression did not end, it just became more sophisticated, and in the 1980s and 90s, central banks coordinated gold sales to keep prices low during a period when inflation should have sent gold soaring. The Washington Agreement on Gold in 1999 limited central bank gold sales to create the appearance of restraint, while also coordinating those sales to maximize price suppression. And the Fed uses the Exchange Stabilization Fund, a secretive treasury fund that operates with no congressional oversight, to intervene in gold and currency markets during crises. The ESF was created during the Great Depression and has been used repeatedly to manipulate markets, including gold, and its operations are classified, so we do not know the full extent of intervention. Why gold should be much higher. Here is what gold should be worth if markets were free and fair. Since 2000, the Federal Reserve has expanded its balance sheet from $800 billion to over $8 trillion, and that is a 10 times increase in money supply. The European Central Bank, the Bank of Japan, and the People's Bank of China have printed tens of trillions more. If gold tracked money supply growth the way it did historically, gold should be over $10,000 per ounce, not $2,000. Global debt has exploded from $80 trillion in 2000 to over $300 trillion today, and that is a 400% increase. Government deficits are permanent and spiraling, and inflation is structural, not transitory, and currencies are being debased at record rates. And yet gold has barely moved compared to the scale of money printing, and this is not natural, and it is not market forces. The only explanation is active suppression, because a $10,000 gold price would signal that fiat currencies are collapsing, and central banks cannot allow that message to reach the public. Think about this, and gold is the canary in the coal mine for currency collapse, and central banks are suffocating the canary so you do not notice the gas leak. What happens when the manipulation fails? Manipulation cannot last forever because eventually physical demand overwhelms paper supply. China and Russia have been buying thousands of tons of physical gold and moving it out of London and New York and into their own vaults, and they are de-dollarizing and accumulating hard assets. Central banks globally have been net buyers of gold since 2010, reversing decades of selling, and they are preparing for a currency crisis even as they suppress the price. And retail demand for physical gold coins and bars has surged during every crisis, yet the paper price barely moves because the manipulation absorbs the demand. If a major financial crisis triggers mass delivery demands on COMEX, the system could break, and if even 10% of paper gold holders demand physical delivery, the exchanges cannot meet it, and the manipulation collapses. When that happens, the gold price will not rise gradually, it will gap up violently because there is no physical gold to meet demand at current prices, and the real price discovery will be shocking. This is what happened with nickel in 2022, when the London Metal Exchange had to halt trading because a short squeeze threatened to bankrupt the entire exchange. Gold is bigger and more important, and when the manipulation fails, it will be catastrophic for the dollar and for central banks and for anyone holding paper promises instead of physical metal. The lesson here is what gold price manipulation teaches us, and the system is rigged not in the way most people think though. Gold is not suppressed because central banks are evil. It is suppressed because they are terrified, and rising gold prices expose the truth that their currencies are worthless paper-backed by nothing except confidence. Every dollar, every euro, every yen exists because the central bank created it from nothing, and the only thing giving it value is the belief that others will accept it. Gold does not need belief, and gold is valuable because it is scarce and cannot be printed, and has been money for 5,000 years. So central banks must suppress gold to protect the illusion that paper is as good as gold, and they do this through paper gold that does not exist, and through coordinated selling, and through futures manipulation, and through opacity and secrecy. The manipulation creates opportunity, though, because when you buy physical gold at suppressed prices, you are buying the most undervalued asset in the world relative to money supply growth. Paper gold is a scam, yet physical gold in your possession is the only money that central banks cannot print and cannot confiscate and cannot manipulate once you hold it. The manipulation will eventually fail because you cannot suppress reality forever, and when it does, gold will not just rise, it will explode. And the people holding paper promises will learn that paper gold is worth exactly what it is in paper. If this story opened your eyes, subscribe to Paper Empires. History has the answers, and we will show you where to look.